The big news we didn't get to yesterday, the Chalice study.
Obviously, people would have seen that the stock was down 25% yesterday and another 5% today, so the market hasn't taken it too well.
The biggest barriers to entry for this, if you look at processing, you look at permitting, you look at the huge funding requirement, the time, where do you rate each of them, mate?
I think that at every stage the company have challenges. I think the ore body, as I mentioned, it's on the lower grade side. Even in processing, you mentioned Keith Good. He's a pretty well-known geologist. He said forget about the oxide, and why that is because if you read really carefully in the scoping study, they actually have not been successful in treating or recovering the oxide. They say that they've tried a number of different methods without success.
What the fuck? What are we? 31st, eh?
Thursday.
Well, Money Miners, welcome to the show. Thursday, 31st of August, last day of winter. The weather's improving, loving it.
It feels like spring already, I must admit. My hay fever is going bonkers, mate, so it must be spring already.
Bloody love it. Right, we've got a big show, so we better just rip straight in and I'll try to not talk too much shit. We're getting deep into Chalice.
Yes.
The scope and study. I couldn't do it yesterday. We did the rare earth spectacular. Head back and listen to that because you'd be fucking mad not to, with DK from Terra Capital. We've got a special guest for the Chalice thing today, give a bit of additional insight to what you boys have done such a sensational job on. Datt from Datt Capital.
Yeah, the much-awaited scoping study.
True friend of the show. And we're also going to cover 29 metals they ended up raising. Who would have thought? Some interesting questions and comments on the investor call from yesterday, which we are going to play for you.
And really interesting price dynamics going on as well, which hopefully we can add some colour as to why.
Yeah. All very interesting. Right, let's get. I didn't want to give too much away. What you were looking outside, JB? What the fuck are you looking at? That car parked all fucked up. Is that what you were looking at? Right.
I was thinking I'd said much awaited, but I think the right term is much anticipated.
That's all right.
We'll get there.
Don't read into it too much. Right, boys. Partners today: JP Search, Michael and Zav. Absolute GCs.
Zav.
I want to know, Matty, you played golf with them on Friday. Is their golfing ability as good as their ability to find and place talent in,
mate, I can
in
answer.
funds, investment banks, family offices, corporates, and the works?
Mate, it's just funny you say that. Coincidentally, we were going along and there was a group ahead of us that bloody were holding us up. They led us through, and just like Michael and Zav can't help themselves, I went and talked to him, asked him about this bloke was, in the finance world, coincidentally, and by the end of the
At the Cottesloe Golf Club.
by the end of the round, we get there and he'd already got him a new job.
Oh.
I couldn't. I saw it live with my own eyes, just like that, and this guy was already an elite. Got him a CFO, fucking unbelievable.
Amazing. Was his name also effing?
No, that was he. This guy was a bit more higher stature than Frank. He wasn't down on his luck. Mate, thanks for the game, JP Search. Hit him up for any corporate recruitment, CFOs, and all the like.
Seriously, give him a buzz. Check him out.
Yeah,
Do it.
absolute GCs. Right, boys, the big news we didn't get to yesterday, the Chalice study, CHN. And look, we're in the process. You boys are going right deep into it in the research, but why not just add a bit of armory to the whole thing and bring in a guru?
Can I add some
in addition
context?
to you two gurus?
Well, this is wicked, right? A bit of colour on the guest that we've got joining us. I was on Twitter about, I reckon 40 minutes before we're ripping the episode, Matty, and I notice a certain Mintwit character who happens to run a fund over in Melbourne, who's also been a guest of the show several times, Mr. Emmanuel Datt. He posts a poll, and his poll is, would anyone be interested in a thread on CHN, which of course is what we're going to talk about. And JD and I have just written a bunch of notes, mostly JD, but we've written a bunch of notes on it. So I responded, yes, I do, but how about you do one better and join us for our deep dive on the podcast? And he said, sure.
Consider it a video thread, Manny D.
Yeah, for sure. Thanks for having us,
Mate,
guys,
welcome
again.
Oh, mate, this is what, number 3 appearance for
Yeah.
the Datsun 180B. We appreciate it, mate. Right, boys, how do we want to lead it off? Do you want to give a bit of overall context on the Chalice operation and this study that's come out?
Yeah,
And we'll get right into it after that.
We'll give a bit of scope on the scoping study, on the pun. So obviously people would have seen that the stock was down 25% yesterday and another 5 today. So the market hasn't taken it too well. So let's just skim the highlights of what's come out and where they were at prior to this to give a bit of context to the discussion. So people might remember they came out with an updated resource in March of this year. That was for 560 million tonnes at a nickel equivalent of 0.54%. So we'll get into those equivalents later on. They modelled out 2 open pit cases, 15 million tonnes per annum and 30 million tonnes per annum. And they had a 19 and an 18-year life of mine respectively. So the oxide part of the project was going to result in a PGE gold doré, and then the sulfide was going to produce 2 concentrates. And again, we'll touch on them later on. They, in terms of the cost curve, put themselves in the second quartile. It's quite an interesting looking cost curve given that one project takes up more than the entire first quartile. That's obviously on their numbers. In terms of pre-production capex, Aussie $1.6 billion for the smaller scenario and $2.3 billion for the larger scenario. And they spat out...
You had to dig a few pages to find that one, didn't you, Jay?
You did. So in terms of MPV, you get a $2.8 billion, again on the smaller end, and a $4.2 billion MPV on the larger scenario, both resulting in an IRR of 26%. 2-year payback roughly for both of them. And just an interesting kind of quirk of this one, given its proximity to Perth, is that it'll be drive in, drive out, as opposed to fly in, fly out, that we're quite familiar here with in WA. And just on timing, they said they'll get to a final investment decision in late 2026 and commence mining in early 2029.
So that's the highlights, right?
Yep.
But with every study, the devil is really in the detail, and I think that's the angle we're going to have with the conversation around this study today. Is hopefully we can look at some of the assumptions and ask the question: are these assumptions reasonable or not? And what does that mean for the economics? And maybe that discussion actually kind of informs what we've seen in the price action since it's been released.
Absolutely, mate. So let's start our analysis by talking about the financial side of things. So I touched on 2 different scenarios there. Obviously, you got the slightly smaller and slightly larger scenario. That's essentially based off a different mine design and different cutoff grades, which is all factored around lower long-term prices in the smaller scenario and higher long-term prices in the larger plant scenario. And like you said earlier, Trav, you had to wade in 10 pages to get to those pricing assumptions, which we're going to unpack now.
I think those pricing assumptions, mate, they are the biggest talking point of this study. There's a lot of discussion about these the selected commodity prices that Chalice has used in this study, and I think we're going to try and unpack that point as much as possible, because if you look at the valuation, it's more sensitive than anything to price. So
absolutely, it's completely in contingent on whatever the prices you chuck in those models. And we talk about this all the time when we talk about equity research reports. What are the assumptions? So
Case 2, 30 million tonne per annum.
Crazy, right?
That is like...
The smaller scenario is 15 million tonnes per annum, which is huge.
It's a massive mine.
And so I guess the money miners that want a bit of context on how big that is. So I think Boddington's one of the biggest ones. I think you found JD in Australia. That's 40 million tonne. Cadia is 32 million tonne. I think Telfer was 18 million tonne.
Yep, we touched on the...
KCGM's upgrading to 27. So
Exactly.
30 million tonne would be one of the biggest processing operations in Australia.
Just massive, right? So on those pricing assumptions, palladium first up, US $2,000. So 55% of the revenue of this project will come from palladium. So it might not be an element where super
55% at $2,000.
at $2,000 tonne.
It's not 55% if you use more realistic
Massively,
price.
massively contingent. So we're at, from memory, a bit under 1,200 right now in terms of pricing on that one. And then you get nickel, US $24,000 a tonne, where in 2023 sitting quite a bit below that. The nickel price has come off a bit. And again, on their modelled scenario, 24% of the revenue of the project comes from nickel. And then you got copper at US 11,000, platinum at 1,000, gold $1,900, and cobalt US $46,000. So on their numbers, I think only 4% of the revenue is coming from cobalt, but that is substantially higher than where the current spot cobalt price is sitting.
Yeah, and this is the kind of the context that we want to talk about. So you look at the rationale that Chalice have given for the selected prices that they've used here. And they have a paragraph in here basically stating that long-term commodity price forecasts were sourced from AME Group, and they've used long-term prices based on this price decks that were provided by AME Group. So they're an external consultant similar to a Wood Mackenzie, where sometimes you can get these price decks which you can use in your studies. AME Group have provided the price decks. As a reader of this study, it reads to me like they have used nominal prices in a study and comparing them to with real capex figures. So, I'm going to add some color why I think that. Like, you would normally be extremely explicit about the fact that you're using real prices, i.e. the prices chosen are denominated in real 2023 dollar terms. There's no color about that, mate. This paragraph includes none of that. However, when you get to the capex assumption detail, it absolutely does tell you that this capex is in real 2023 dollars. So I read that paragraph and I look at how absurd these long-term prices are. And the only way I can actually justify it is if they've actually used the nominal prices and real capex figures, which is just an absolute no-no when it comes to sensible economic modelling.
It's frustrating that it's not written out more transparently. And let's flick over to our guest. I'm really keen to hear what you have to say, Manny, about the pricing assumptions in the study.
Was it one of the first things you noticed?
Yeah, absolutely. And I think you guys have hit the nail on the head. So I guess basically what they've tried to do is they've tried to extrapolate or estimate commodity prices from the start of production, so out to 2029, which is quite some time away. But then, with the capex, they've estimated it in today's dollar terms. But if you were to apply the same, or if you were to just assume, say, 5% inflation over that period to production, you'd wind up with a capex figure that's 30% above what was estimated. So significantly more than what they've disclosed. But then again, it is a scoping study, so that is sort of plus minus 30%. And the way I've always seen scoping studies is it tends to be more towards the plus 30% rather than minus. So,
and when you put that in just the case where they said no permanent village is modelled to be drive in, drive out, I've just done a Google Maps and it's 93 k's from here. And imagine how many people you would need to supply a 30 million tonne operation. I don't think you'd be risking they're all going to be far north of the river and driving 60 k's every day.
Boddington's drive in, drive out, isn't it? And that's
when they say drive in, drive out, it depends if they've got a village there. So it's drive in, drive out to get there, but then you stay while you're there.
I see what you mean.
So if they haven't modelled a permanent village, that would indicate that they're expecting people to drive in and out every day. Live nearby and drive in and out every day, which some would.
Yeah, so I think
it'd be hard to get all your workforce to do that.
I think
this is way down the bloody road.
Yeah, they touched on having a camp there for the construction period and then no permanent village sort of thing.
So just to add a bit more colour on the prices, I thought the reasonable thing to do here is to look at the prices they've chosen for the 6 commodities that they're actually getting revenue from, compare them to the spot prices, and also compare them to what the long-term real dollars, 2023 dollars, consensus price forecasts are for each of those commodities, just to see how out of line they really are. So the source for my consensus long-term real prices here are the consensus from Consensus Economics. What they do is they look at what all the brokers and forecasters do and they take an average. So I've not cleaned that data for people who aren't familiar with resources. I've literally just taken the average of the data set. The ones that really stand out, of course, you can see that almost every single price is that they've chosen is actually higher than current spot, but they're also almost all substantially higher than the consensus long-term real prices as well. And if you focus on the 2 metals there that account for the majority of the revenue in their study, palladium and nickel. In the case of palladium, the $2,000 per ounce is about twice as high as the long-term real consensus price for palladium, which is $1,043 per ounce according to consensus economics. And then the nickel, their $24,000 per ton is about 30% higher than the $18,000 per ton that you see that's consensus at the moment. So that kind of just frames a discussion on why we're so focused on price, because that really drives the NPV of this project.
Absolutely. So something that companies will almost always do is chuck in a sensitivity analysis, and they do an interesting one here. They chuck up their sensitivity analysis, of course, across both cases, the 30 and 15 million tonne per annum case. But something you pointed out, Trav, which is it's a bit frustrating, is that you have it for PGE prices and then you have it separately broken out for base metals prices.
Yeah.
And then the NPV adjusts, plus or minus 25% in each case, which is what they've modelled. But from that, you can't deduce what the NPV result would be if both at the same time are, 25% lower than what they've modelled, which is just another frustrating
the
one.
NPV tornado would be familiar to every banker out there. And the way you normally show this is you flex all commodity prices negative plus and plus and minus 25% at the same time. You don't separate the two subsets of commodities and then apply a price flex to both of them, because then what you're supposed to show is those two effects at the same time. But now you've got this counteracting force, one's still high and the other's low. It's just not how you do things, right? If they did do things like that, you would obviously see much lower NPVs. But the common theme throughout this study is some of the assumptions are very questionable to sort of potentially juice the economics to be a bit healthier.
Agreed. So moving on to the cost curve, this is something we always touch on in our analysis, and something that's that stands out straight away when you're thinking about how the cost curve is going to look is what commodity are you talking about to start with, because they're a huge polymetallic system that they've got. So we're talking about it in a sort of a PGE type sense. So to get to the actual cost curve numbers, you're subtracting the byproduct credits and looking into the detail. They're using 2022 numbers with a nickel price of US $24,000 and a copper price of greater than $10,000. So they compare it to the South African operations, which have limited byproduct credits from base metals, although Chalice do probably rightfully counter that by saying that rhodium was a significant byproduct credit that many of those South African operations have, for which Chalice sits much lower on the cost curve. I'm keen to talk about the discount rate now. So they use a 6.5% discount rate. Again, it's not something that's entirely unusual. We do see it quite frequently, but just bearing in mind where we're at in the interest rate cycle. And Manny, we touched on this when we spoke 2 or 3 weeks ago about the whole interest rate inflation cycle where we're currently at. The RBA cash rate is over 4%. The Fed's fund rate is touching on 5.5%. These guys using for a relatively risky project 6.5%. What did you make of that?
Very, very much underdone, I would say, given it's a scoping study. So typically what we do internally is we actually increase the discount rate depending on, the nature of the study itself. So something like a scoping study would use a higher discount rate, let's just call it 12% or so. And then, for a PFS, maybe 10%, for a DFS, 8%. So that way, and that really reflects the level of risk as you go down the sort of study and development timeline. So I think that 6.5%, it's way underdone from my perspective. And just showing just the preciseness of that discount rate kind of tells me that the numbers were maybe massaged to look, or goal seek.
7 wasn't quite what we wanted, so we'll go 6.5.
Exactly.
Manny, what's the impact of bumping this up to 12%? You'd be a guru on the spreadsheets. What is the impact on the study numbers?
I'd probably say
they don't give you the sensitivity table in the
And I think but look, my estimate would be that the NPV, post-tax NPV at a 12% discount rate would probably be under $1 billion. That's just a sort of rough estimate off the top of my head, so don't quote me on it.
To that, Maddie, a question and something we've raised quite a bit in the past is the sort of ratio. It's a rule of thumb, a thumbsuck type of analysis, but the CapEx to what the ultimate MPV is. And again, you can change the discount rate here and there, but we don't obviously talk about projects so favorably when the CapEx is 2 times the result, the MPV. You know?
I think that's is that a bit of a golden rule, Manny? If the CapEx is significantly higher than the MPV, it's not looking too good. Or not?
I'll let Manny answer.
Yeah. Well, there are a number of ways you can look at it. I think one measure or ratio that we use is capital efficiency. So basically NPV over CapEx. So ideally, for a high quality project, that should be a multiple of CapEx. Something like Adriatic Metals, for example, has in their studies they had a capital efficiency ratio of about 6 times. This one is probably like 1 to 1, I would estimate, if they, assuming that all the baseline assumptions are sound, which they're clearly not. So I think it's going to be one of those projects that's going to be hard to get off the ground without further sort of refinement and improvement.
To your point, Manny, on the discount rate and the way that you sort of lower it throughout the development pathway. Yeah. I think the point there is that discount rate is supposed to capture the risk. Correct. And I think a reader of this study should just ask the question, do I think a 6.5% discount rate adequately captures the real risk of the project?
Correct.
We talked about risk and difficulty yesterday in the Rare Earth Spectacular. I think we can throw PGEs into that, multi-element deposits like this and PGEs into that mix.
Well, speaking of one of those risks, Maddie, going a step back from the financials now, let's talk about the recoveries and the payabilities, because they obviously have a big impact, sort of secondary to what the pricing assumption is. They have a big impact on what the NSR, the ultimate revenue that the project can achieve. So starting with recoveries, the company did flag that limited testing had been done to date, but something that we were aware of is that a lot of the test work that had been done prior was on relatively higher grade dirt. So the newer numbers coming out around recoveries aren't exactly filling the market with confidence. And I do think that is one of the bigger reasons sort of playing on why the stock got marked down so significantly yesterday and again today. And, you could sort of argue that the market perhaps got a bit of ahead of itself. It could have seen this. I don't think like the company hid these things or anything. We've been speaking about it. It's a risk that's always sort of been on the table. On payabilities, I just want to focus on palladium and nickel, as like we've touched on, they're the biggest drivers. So they're assuming 96% payability for palladium. And, the reason they say this, what they do to back it up, is that they say there's very little deleterious elements involved. And, in terms of payabilities, it's pretty hard for me to add significant value beyond stating the obvious that 96 is a pretty high number, and it just adds another layer of risk to the project when you need to check that box just to make the numbers work. I'm not sure if you had any sort of added insight into that one, Manny.
Yeah. And I agree with you. I think the payabilities look incredibly high from my perspective. I think that something closer to, somewhere within the high 70s to low 80s, I would probably say is typical. But of course, that does vary according to the nature of the contract and the other sort of treatment charges and all those sort of things. So, agree with you that these payabilities look on the higher side.
Well, a 70 to 80% payability versus a 96 is a really big difference.
Yeah, for nickel specifically as well. So they flag slightly lower, and they do reference a number around 80 being much more common for nickel.
Yeah.
But they say that as a result of their higher grade nickel product relative to other mines in the state and globally, they see it warranted that they get a 90% payability for nickel. There's one more aspect one more sort of macro aspect that I want to touch on, and that's talking about strategic alignment and price bifurcation. Price bifurcation is something that's come up quite a few times in interviews that we've done, notably with the Wyloo guys. We spoke about it in the context of nickel, and I think that's why it comes to mind again. But it was interesting to see that Chalice explicitly named, countries. They're talking about China, Russia, South Africa, Indonesia. They're explicitly mentioning these, what's also known as BRICS nations, and saying that they are strongly Western aligned, so counter to these BRICS nations. And it's kind of interesting because you'd need to be, fully integrated. That's what they're talking about. You don't want to be. It doesn't work if you're sending your concentrate to China or anything like that. So it's doable. It just adds another layer of hardness. And then they, in reference to that, talk about potential government support, royalties, grants, incentives, and things like that.
I read this piece of it, JD, and I can't, with the cynical lens on, I look at it and think, well, everyone's going to read through the price, the incorrect price assumptions is where you interpret it. And so they kind of need a bit of a narrative to substantiate that. This is the narrative. But I think if that was the only take, it would probably be the wrong take, because there is probably some merit to this as well. It's just you can't necessarily count on it. It's sort of like it's not a defensible position to say, we think we will be able to get a higher price in the future because we haven't seen that bifurcation develop in all of these commodities yet.
I couldn't agree more. It's very hard to quantify, and it's not something you want to pin any sort of expectation on, although there is some sort of merit to it. We've seen things like the IRA that we've discussed at length, can add value to ex-China projects, Western aligned projects, but you really want the project to stack up on its own merits prior to factoring in any potential upside that you might see from these sorts of incentives and bifurcation in prices and the like.
Anything to add on that one, Manny?
Not too much. I think you guys covered it off pretty well. And I guess that the other thing to throw in there is whether the commodities that this project is producing are considered strategic. I would probably say probably not at this stage, but you never know what will happen. But you can't sort of take that to the bank, I would say. And I think it's a speculative sort of aspect of the project at this point.
Well, before we get into, I guess, the pricing of Chalice before this study came out, Manny, before this study, what did you think of Chalice as a stock, as an operation, as a potential developer?
I think that just taking it back to fundamentals, it's all about the resource ultimately. And one thing that was pretty clear to me was that, sure, this resource looks pretty bloody big, right? But also it's pretty low grade. That's something that you can't really get around. And so I guess this study itself, it's not really a surprise to me in the sense of what the outcomes are and how the company have tried to portray it. So so I don't think it's anything it's not a surprise to me, basically.
Trav, did you had a bit of a comment about the nickel grade that you heard from, unless you've got this coming up later. But
I think this is the right time to talk about it, right? It's you talk about the resource there and the grade there, and I think if you were to have a conversation with someone in the industry on the street and you ask them, what do you know about the Chalice mineral resource? And they'd probably say something along the lines of, it's pretty bloody big. They'd probably say something like, it's about 0.6% nickel equivalent, but there's a high grade bit which is about, just less than 1% nickel equivalent. That's probably what they tell you, right? And I think because those are the numbers that stick in people's head, that kind of actually misguides the narrative a little bit, because talking in denominating in nickel equivalent grades is, I think, a fallacious way to think about this mineral resource. I'm kind of keen to unpack why that is, and to do that, I'm going to end up going into the minutiae of how an equivalent resource grade is actually calculated. So I'm just going to give a bit of a notice now, a risk that I might lose you talking about math equations on a bloody podcast.
Manny D. Strap in and butt in whenever.
I'm sure Manny will be able to say it in simpler words than I am, but I'll just keep it at the sort of intuition level, right? So let's start with how a resource equivalent calculation actually works. The calculation captures the impact of the relative prices of the commodities. This bit's well understood, right? You're making the equivalents and you're capturing the relative price differences. You'd normally use a long-term price for that equivalence. But it also captures the impact of the relative recoveries of the two commodities or multiple commodities within the deposit too. And this is where things get a little bit funky, because the commodity you choose as the base commodity in the equivalent calc, that can impact our interpretation of the numbers. I know this is a weird...
So that base commodity is the one that's referenced here. So nickel has been chosen as the base one.
Yeah,
for this?
to be clear, Chalice don't only quote the nickel equivalent. That's just the one that's stuck in our head.
Yeah.
And maybe that's, us, the reader's fault, but that's the one that, in the market is the known number.
They do quote a palladium equivalent of 1.7 grams per tonne as well.
Which doesn't mean anything to anyone because no one knows what the fuck's good palladium and bad palladium.
Hence nickel sticks in our heads.
Yeah.
The minutiae is like, if you choose the commodity with the lower relative recovery, that has the impact of lowering the net smelter return per base tonne of that one commodity, nickel in this case. So hence denominating in that inflates the grade equivalent per tonne. In Chalice's case, palladium makes up the bulk of the payable metal we talked about at the top. But the grade people remember when they think of it is the nickel equivalent grade. And I think, we can provide a link to some worked example if the money miners want it. But I think where we get in trouble is we talk in these nickel equivalent percentage grades. The real solution around this is actually, if the industry agreed that looking at the net smelter return per tonne in the ground is actually the better way to think of the economic grade here. Any thoughts on that one, Manny?
Yeah, sure. So I think probably the correct way to do it is to split out each commodity in its own right, and attribute a spot price and a percentage of the commodity that exists in the ore. What Chalice actually do is they just use a static ratio in their nickel equivalent. So, for example, I was looking at this. They assume that cobalt is 3 times the price of nickel in this nickel equivalent calculation, which is probably appropriate as a snapshot, or it may have been appropriate, at the time of the mineral resource estimate. But it really should be done on a spot basis, I think, and that's the way we tend to do it. And ultimately, that is what gives you, a value per tonne of ore, in situ, I should say, without any sort of recovery factors or mining dilution or anything like that. So it's a bit of a complicated process. And in this particular deposit, we've got a whole range of commodities in there. But that's like, if you want to sort of model it out quite accurately, that's the best way to do it.
It's funny, right? As I was saying to JD earlier, the amount of times I've worked in an Excel workbook and you're inputting a mineral resource and you work out a metal equivalent as a banker, you do it all the time. It's part of your comp workbook, right? But you rarely, for the purposes of a banking comp workbook, you don't actually input the recovery factors there.
Yeah.
And it's the recovery factors that can misguide the interpretation of grade as it relates to the unit denominated in nickel in this case. Yeah. And I think in the case of PGEs, the convention for a lot of these resources is actually to include the payability factor into that resource equivalent.
Yeah.
As well.
Yeah, I think it's pretty astounding. When you look, they break out the overall metallurgical recoveries, and just to read out some of the numbers from the sulfide part of the ore body, you got palladium at 78%, platinum at 45%, gold 66%, nickel 43%. The recoveries really matter.
Mm-hmm.
So why don't we get into what some other people around Australia are saying? Trav, you broke out a cross section of what the people from Mintwit are saying, and there's some interesting tweets out there. There was some good value add, I'd say. What were the ones that stood out to you?
All right, I got to give credit. I think there were some really good takes on Twitter on this one. I think the takes on Twitter were better than the takes we've sort of seen elsewhere. To be honest, they're pretty good takes. So Mondi says he takes a screenshot of this front page of the announcement. And he's highlighted the very first dot point. The first dot point says positive scoping study. And Mondi says, the dreaded, in quotation marks, positive study usually means it isn't. And he's referring to Monty's got a bit of a rule. The moment that positive is in the title or a highlight, they're trying to tell you what to think before you have the ability to think it yourself, which
The
normally
MPV
means
is above zero. That's all it's positive.
This one was so good, we both actually put it in the notes without realising. And I think in another tweet, the way he'd worded it was positive equals underwhelming.
I like his rule for that one. I'll be keeping an eye out for it myself. Respeculator, he says, when you open up a scoping study and can't find the financial highlights till page 10, they use the price decks and the highlights are all, in quotation marks, ESG crap. You have yourself a lemon. And he's used the emoji lemon. Very funny, Respeculator. Our good friend Bogan Geologist has retweeted Respeculator's initial tweet and he says, well, CHN burying their capital costs 42 pages in and running their study on the metrics below Fermet. Negative 20% ain't so bad. Nice one, Bogan. Also a friend of Manny Datt's. So ASX long short, he's got an interesting take. He's got a whole thread here. I won't read it all out, but I will read out the bit I've highlighted at the very bottom. He goes, TLDR, long-dated DCF valuations are a joke. Price discovery in these stocks is dictated by the stars and people in strip clubs at 11 p.m. on school nights. I think that's the counter argument to, like, we're talking about a study in DCFs and NPVs and assumptions and all that sort of stuff, and the counter argument is it's a strategic asset. You got the super long mine life. These things do trade at a premium when they transact, and hence it justifies a premium valuation. That's the counter argument. We're going to get bogged down in the weeds of a study because that's what we do. But that's the other side of it, and it's a fair take to have.
Manny, have you got another one?
Well, I got a couple more, but I'll let you break.
No, you're right.
It.
Keep them rolling, Trav.
Yeah,
I don't want to interrupt the flow.
Here's one from Keith Good. He goes, he's responded to a point. And he says they need to ignore the oxide and just focus on the sulfide. No PGE operation uses POX/autoclaves. It's the probability rising from people without PGE knowledge. South Africa PGE companies have tried almost everything and rejected it for its conventional route. So a bit of a recommendation for the guys at Chalice there. And then I'll round it out with one from Twin Turbo Silica. What a load of crock. CHN using 2029 metal prices, but using 2023 labour and equipment prices in their study. And Aaron Colleran, he's commented on Twin's post and he says, what surprised me most yesterday were the big bank analysts that just agreed with the scoping study and maintained their buy recommendations. No analysis at all. The brokers would have seen straight through it and hit sell. And I think, we're speaking to the dynamics we saw on the screen in the last 2 days since this has been up.
So, Manny, if you looked at, I'm assuming you ran your eye through the processing and everything, I guess what do you see, or you might have to name a couple here, but the biggest barriers to entry for this, if you look at processing, you look at permitting, you look at the huge funding requirement, the time, where do you rate each of them, mate?
I think that at every stage the company have challenges. I think the ore body, as I mentioned, it's on the lower grade side. Even in processing, you mentioned Keith Good. He's a pretty well-known geologist. He said, forget about the oxide. And why that is because if you read really carefully in the scoping study, they actually have not been successful in sort of treating or recovering the oxide. Yeah. They say that they've tried a number of different methods without success. Hence, they're just focused on a type of leaching for that oxide layer. However, the oxide, as many listeners will probably know, is the shallower part of the ore body. So it makes it...
the first bit.
Yeah, exactly. They're kind of, in between a rock and a hard place in terms of the shallow.
What is the oxidation profile there, Manny? How deep is that oxide layer?
Oh, I believe it's down somewhere around... I'd probably estimate about 100 to 200 meters deep, or maybe actually a little bit less. Sorry, I'm just looking at it visually, so it's just a guesstimate. But they've always
that's a lot of stripping.
Yeah. Well, they've always,
if you can't process it, that's technically stripping.
Yeah, exactly.
And it's interesting to that point. They talk about open pit scenarios, but they also talk about assessing putting in early, development in to go underground.
Not for a 0.6% nickel deposit either.
Yeah, so it's a bit of an interesting one.
Equivalent.
It would pull forward those development costs. You often see that after they've had significant cash flow from an open pit operation, then you chuck the decline and so on.
Yeah.
So it's a bit of an interesting one. There was one other plant, I'm not sure if you picked up on, Manny, because they didn't really mention it explicitly, but we heard a bit of commentary around a desalination plant that might be needed that's CapEx managed to slip off the scoping study. This operation would obviously need a significant amount of water once it's up and running for the processing and those sorts of things down the track. And yeah, I mean, I'm not sure if you picked into this or heard any sort of commentary around it. It was something that was just called out to us earlier.
Yeah, absolutely. And it does make sense, right? If you're constructing a 15 million ton operation in the base case, that's going to need a hell of a lot of water ultimately. It doesn't appear that they have really sort of made a lot of progress on this aspect of the operation. And it's probably, something that they've got to progress over time as they make their way further down the studies.
There's one more thing I want to get into, guys, before we have a bit of fun doing some predictions for what's going to happen to Chalice in the future. But it's perhaps the only positive take we're going to have this whole discussion about the company. But given that the share price has come off over 30% in the last couple of days, does their, the partnering process that they keep talking about actually look a bit more enticing now for any of the majors out there? Do we see it as, a more likely scenario that one of the majors around the world could justify coming in now that it's no longer got, a big 2 in front of the market cap or, 3 at some point? Now it's, I think the last time I checked, the market cap was 1.4 billion. I can't remember off the top of my head what the EV was. But do any of us think it's more likely now that the partnering process works?
I think, on a like-for-like basis, valuation's more attractive, but you're now more aware of the risk. I think in a partnering process, if I was someone who had funding and execution capability, I'd be looking for permitting risk to be eliminated before I really got interested.
Yeah, absolutely. I think permitting risk is always front and center with these sort of big bulk operations. I think probably just to throw a question back to you, do you guys see any difficulties or foresee any difficulties in getting an open pit of this size permitted so close to Perth itself?
Oh, in a beautiful forest area.
Yeah.
Yes, I do.
What could go wrong?
I do see a lot of difficulties.
What do you, Manny? What do you think? Now, this is like you're talking big dollars here, and there's just a few people in Australia that could fund something like this. And it's people like Twiggy and Gina go for this, but
there's companies as well that could.
The big dogs, but like someone that's going to really. They nearly need to go out on a limb for a cause. And Twiggy comes to mind, like with his hydrogen, where he's going with hydrogen, and palladium's the biggest revenue part of this operation. And it would have to be underpin his vision for hydrogen and for him to invest. It'd be something like that to get this going. And
to that exact point, Matty, it's really interesting, harping back to something that Manny said earlier. It's not a critical mineral project that comes to mind. It's not, there is a good portion that comes from nickel and so on, but it's not like a lithium project where, you can say you're doing all this for the EV revolution and so on. It doesn't have that same sort of branding attached to it, right?
Manny, who do you reckon, if you're going to pick a few companies or people or organisations that you think that could possibly fund something like this for the long term?
Well,
who would you say?
Well, I think it ultimately comes down to who would be interested in this. And I would probably say at this level of study, no one. And why I say that is because, just looking at the return profile, it reminds me a lot of, a number of big nickel laterite projects out there that would have, similar amounts of capex that would be required, but you'd obviously be getting, mostly nickel. And which is, what everyone seems to be after these days in terms of the green metal theme itself. Palladium, I'm not too familiar with that market itself or who would be interested in that, given that it comprises 55% of
catalytic converters.
But it's for hydrogen transportation as well, isn't it?
Yeah.
I think catalytic converters are the big one.
I think at the moment that doesn't make up a massive amount of the market. Right?
But it's
Potentially.
potential.
the growing market.
Yeah.
There's that supply-demand gap, Trav.
Yeah.
Yeah. So a lot of question marks around this. That's sort of the point I'm trying to get at, I guess.
Yeah. The PGE, like I look at the producers globally and you go, okay, like almost all that comes out of Russia and South Africa. I think that I read something not too long ago that there were some Navy ships that were like in the ports of South Africa and they were from China. And I read that article and got the impression, is South Africa aligning themselves with China? And if so, then I can understand the strategic importance if this is like, if China, Russia, South Africa are sort of aligned from a geopolitical kind of perspective, then that obviously does make, their the PGEs sort of, super important to the rest of the world. And I can understand that angle, but I just don't know if that's the reality or not.
Yeah, I mean that's explicitly what Chalice have called out in this report, right? Naming each of those countries, talking about the BRICS.
A lot of things to play out, a lot of years away before this thematic gets underpinned, I'd say.
Yeah.
Righto, Manny. All good?
Yeah.
Oh, mate, it's hard to let you go, Manny, because it's such a privilege to have you every time. It's just like, it's like,
appreciate your time,
it's like
Manny.
saying goodbye to me kids each day. It devastates me letting you go.
No worries,
That's
guys.
wicked.
Well, thanks for having us. And it was fun.
Are you coming over here anytime soon, Manny?
I'm not sure. Maybe in a few months or so. Might make a quick trip down over summer. So.
Oh, obviously would be at the forefront of your mind to catch up with, mate. So make sure you pop into the new office.
Absolutely. Love to get a beer.
Thanks for your time, Manny.
No worries. Cheers.
Good on you, legend.
Yeah.
Cheers, mate.
Bye-bye.
Right, beauty. Good in-depth chat. So overall, Chalice, going to be tough. Probably. What's your prediction, Trav? You had a pretty good prediction. Pretty bold.
It's the one that it just would come back to bite me if I was wrong. I'm cynical and yeah, I think I wouldn't be surprised if in 15 years it still wasn't developed. It just might not quite get there. That's my prediction.
Yeah. Righto, let's get on to
29 medals.
equivalent positive news. 29 medals. So, well, what do you know? Last week there was was it 10 days ago?
Who would have thought 10 days after saying they're not raising?
So the
they would do a
AFR,
raise?
there is an AFR article that came out saying that 29 Metals was sounding brokers for $100 million US raise at 40 cents. They were sitting at about 70 cents, I think. It got retracted immediately based on the request of 29 Metals, and 29 Metals said.
Well, we don't know if it was the request. Yeah.
But they said it's factually incorrect that they weren't sounding for a raise. And then, as you said, 10 days later, they announced a non-renounceable rights issue, one for 2.2 shares to all existing shareholders, $151 million Aussie at 69 cents a share. So, and something I learnt and asked you boys, non-renounceable just means that for a rights issue, you can't transfer the rights between two other shareholders. You have to take them up or you don't get them.
Yep, so it's available to all existing shareholders.
Yeah. So the announcement came out today, 97% of the institutional investors took up the insto offer. So that accounted for, I think that insto offer was for 122 million of it.
Yeah, EMR being, I think, 67 Aussie million of the 151
million they took up. So they maintain their 44.85% shareholding. It's across three entities, but they're all EMR. So and then so there's still 28 to 29 million available to the retail shareholders. So it'll be interesting to see how many retail shareholders take up the offer with 29 Metals. I would predict it to be, I couldn't say 100%, that's for sure.
Oh, you never get 100.
Yeah, but
it's always a short.
Do you reckon you get 50?
I don't know. I'd be curious to find out. I think, I don't know. It's hard. It's sometimes hard to predict these things.
There's plenty of interesting dynamics about this one. First up, that stood out to me, the discount wasn't that big, especially in the context of the beaten down companies that have done raisings in the last quarter or so. I think it was 8% discount that they did this in. So if you reflect on what the AFR article said, in terms of dollar value, they were pretty close, spot on. But the share price that was being sounded out was quite a bit off the mark, right?
Yeah, it was. I think the share price was drifting down because the market knew there was a funding gap to solve, and sometimes the share price is going down because you've got that hedge fund dynamic where they're shorting because they can close it out at the discount, and then it's just like this self-fulfilling prophecy almost, is more selling because there's more shorting.
A lot of those
you need the discount.
self-fulfilling prophecies these days.
And in this case, maybe they were able to do it at a tight discount. Good on them for being able to do that because it had already run down.
And you've got
knowing you got the EMR support,
exactly.
That'd be a big driver,
Big
wouldn't
factor.
it?
Yeah.
And they're pretty much got a gun to their head and they have to participate.
Oh, they don't
way.
They don't have to, but
Geez, it'd look fucking bad if they didn't.
Bigger discount if they did.
Now, look, they were up 19% today.
So there's a few interesting dynamics. So speaking to what you'd mentioned, the often seen dynamic of selling into the, shorting into the potential raise and then buying it back up in the placement, returning the stock to the owner.
There's a
of
catch
that stock.
this time, JD.
There's a catch. That only works if there's a placement. It doesn't it doesn't work if it's an entitlement offer like we've seen in this scenario, because you can't subscribe to the new shares being issued. They're only valid to existing shareholders. And then on top of that, something we've learned is that, which makes intuitive sense, you got to offer or give those extra shares so the shareholder maintains their pro rata ownership, to the person you've borrowed the stock from, which can add to a type of squeeze environment that you see, which might be one of the reasons why the stock is up 18% on top of the fact that they've had the funding gap removed. But those people who'd been shorting, going back into the market, buying back the stock so that they can return it.
So to dumb it down, JD, correct me, see if I've got this right. Because there's this rights issue, the shorters had to return more stock than they borrowed.
Yeah, you can think of the people that they borrowed it from. Perhaps they typically borrow from the index funds.
Yep.
And so those index funds by default will subscribe for their pro rata entitlement. So if you've borrowed from them, the way it would then have to work for you if you were short the stock is if you plan to be short for a longer duration of time, maybe now you have to return more stock than you borrowed because that Insto actually wants to take up their rights.
So
that's how
they'd have to
it
return
intuitively.
50% more. So they'd have to buy 50% more than they shorted because of the 1 for 2, or a bit less than 50%.
Yeah, I mean, in this case, it's very contingent on how much is raised in
and
the
so that's
entitlement.
created this so-called short squeeze, bit of a lift. So they're probably just going to buy it, sell it, then short it again.
Yeah, I would say that a lot of these situations would be like unique. I don't think it's a standard scenario. I think they're, depending on what the arrangements are with whom you've borrowed the stock from and so on, I think there's different arrangements each time.
So as I said, AFR had that article out last week saying they were sounding for 40 cents. 29 Metals said they weren't sounding the market for a raise. Listening to the investor call yesterday, Kate McCutcheon from Citigroup had a real punchy question about, I guess, the raising timing and that AFR article, and why not just rip it for the money miners? Access to the investor call, money miners. Here we go.
Hi, Peter and Peter. Thanks for the call. Just on the raise, why not come to the market back in March when Cap Copper was out of action? Why wait till now, and why put out a market announcement 10 days ago saying you won't sounding out for a raise? Has something materially changed over the past 13 days? I mean, clearly raising now is dilutive to the kind of metrics we tend to value copper projects on, like NPV a share.
Yeah, thanks, Kate. You're referring, of course, to an AFR article, which I, of course, need to point out was retracted almost immediately.
Okay, sorry, I was just making the point that you put out a market announcement saying you won't sounding out for an equity raise 10 days ago, and today we have a raise.
Sorry, Kate, I didn't get that at all. So, say that again, please.
Okay, never mind. I will follow up.
Was that like, I don't want to answer that?
That was pretty poor.
Credit to Kate. Like that was great line of questioning, Kate. Kudos to you. I think your research is wicked, by the way.
Couldn't agree more. That is pretty poorly handled from 29M management.
Oh God, another good UNSW alumni, Kate McCutcheon.
Oh, was she in your?
I don't think she wasn't in my year.
Yeah.
Bloody was a bit ahead. Well, wouldn't know me from a bar of soap. She might now. They're quoting her on bloody podcasts and everything.
But yeah, poor response. I'm sick of companies getting away with this, to be honest. Like, I just don't think it's good behaviour. That's my read.
It was, I won't lie, it was probably a lot more delayed than what I thought it was going to be. I thought the raise was probably going to be 5 days later, so they did hold out for a bit. I think we were expecting last week.
Yeah.
Another thing that I guess come out of their results and their the presentation and the call was tailings disposal at Capricorn Copper. It's still the hot topic. So they did provide some colour on the fact that they haven't yet secured a tailings solution, and they predict there's going to be either a production gap or production slowdown in calendar year 24. So for listeners that don't know, the big issue at Capricorn Copper, because of the flooding and the water storage and the fact that it is a sulfide ore body, they are only allowed to dispose of let water go, or a shitload of water go during the wet season. They're not allowed to dispose of it in the dry season. So that the biggest issue is they've got all this water, they've got to treat it, but they're not allowed to let it all go until the wet season comes. That's the big thing.
Yeah.
So,
yeah.
and so look, I won't expand on it too much. Timmy Hoff actually had some questions about it on the investor call too. GC Timmy, I like Timmy.
Timmy's good.
By the way, Timmy's whacked a sell on 29 metals.
Oh, a sell's rare for Timmy.
Sells are rare for brokers. I think the last one I've seen with Johnny Mack on Red 5.
Oh no, there's a lot of sells.
There is a lot more, but there's not. You don't see them too often. So they've put a price target on them for 65 cents. So and he asked a bit about this tailings disposal using pits for it, and also the dewatering at the Esperanza South, where that's up to and where's it going to be stored. So and a bit about the stamp duty. So I'll play that one for you too.
Thanks very much, guys. If we could just double click on the tailings issue at Capricorn Copper, if we have a look at the satellite imagery, it looks like the water treatment plant's still underwater. Water levels are slightly lower in the pit and in the current tailings area. If you were to get the in-pit capacity to put tailings in the old pit, do you actually have sufficient freeboard to start placing tailings in there?
So we currently have an application with the regulator to increase what we call our DSA, Design Storage Allowance. So that's the volume of water we need to have in the pit ahead of a wet season in November. So that application we have submitted is to increase the amount of water that we have in the pit. But currently, fair to say, we need to have a successful wet season.
And then maybe just staying on Capricorn Copper, Esperanza, how much has been dewatered there? How far down the decline are we at the moment?
Haven't yet commenced the watering of Esperanza South. We've obviously commenced restart of Mammoth and Greenstone. We have been maintaining water levels within Esperanza South. The intention would be to recommence dewatering and rehabilitation of ESS in the fourth quarter this year.
Okay, so the water from Esperanza, presumably that's going to be acidic to some degree or classed as acidic. Would that have to go into existing storage for a period of time, or does that require any extra treatment?
So that correct. So that would go into existing surface water storage infrastructure and then be treated for release in the wet season.
Any update on the $26 million stamp duty payment that's due?
No, there's nothing to update. We've had no new news on that matter. Thanks, Tim.
What do you make of that, Matty?
I think praying for a successful wet season is fraught with danger because it'll be a wet season. I you would pray that they would not get a repeat of what they experienced last year, but hoping for a dry-ish wet season of less rain is it's a bit of a risk, big bloody risk. So and when they're talking about that treating, so they've still got all that water to pump out Esperanza South. They've got to get up the storage because obviously the water treatment facility is underwater, so they've got these ponds and stuff they've put in and pretty much pouring bloody lime into it to neutralise the sulfides, they've got to do all that to all that underground water that comes out. So it's just this. Oh, it just sounds like they're absolutely in between a rock and a hard place.
Good pun, mate.
Which bit? The rock.
And a hard place.
Oh yeah, it's a bloody hard place.
It's a hard place because the water actually makes the rock even harder when it bloody all isn't it? Doesn't
it makes the broken rock, blasted rock harder.
Yeah.
So that's what we talked about. The fact that whole cave is still underwater.
Yeah.
So it's going to promote
you got to re-blast it.
Oxidize it, welds all the sulfides back together. So getting that cave to propagate again, even just to start bogging it, it'll just be like bogging a bloody bit of steel. It's very hard to break up. So that's going to be a challenging thing. So they're still waiting on the insurance claim. So they said they did get a portion of it for the surface works. I won't play the snippet, but they were asked about, look, what is the underground component of the insurance claim? Because the insurers have said we're not going to cover the underground, and they are disagreeing with that. But they did highlight that the underground is a much smaller part of the insurance claim. The majority of it is for the surface. They didn't say if there was more coming for the surface, but the underground component isn't as much. Underground component's going to be more a time issue than waiting for the insurance claim. So they've pretty much got all this. Sounds like they've raised as much as they could in anticipation that they might not get that underground insurance claim and they can't rely on it. So you wouldn't say they're bulletproof by any means, because I think Canaccord is still predicting in FY25 until they've got positive free cash flow. They're going to be chewing into this raise and debt and everything, and that $26 million stamp duty payment. So, tough times ahead for them.
Yeah, but a raise they had to do.
Yeah.
Hopefully the balance sheet helps them get there now, mate.
Very much. Right, boys. Sensational. Thanks to Manny Datt from Datt Capital for joining the show. He's welcome anytime, that fella. Absolute bloody gentleman.
Good on him for the spontaneous dial-in. I like that.
He must have wanted to come on. Kind of asked. Right, beauty boys. Tomorrow, we won't give anything away. We were going to get into the Orteco acquisition of the Green Bay Copper Gold project in Newfoundland, Canada, but we'll cover that tomorrow.
Beautiful,
Very
mate.
Interesting transaction and a pivot for that company.
Sure was.
Yeah. So, right, boys. Thanks to all the partners.
Yep.
Topdrill, K-Drill.
Anytime
Exploration.
JP
Search, the Cottesloe Golf Club recruiters. Absolute GCs. Right.
Thanks a lot, guys.
Thanks, Buddy Miners. Hootaroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.